Okay. I know from my inside days that even if you are saying something clever, if somebody is moving around, nobody listens to you. So I will wait 1 or 2 seconds. Okay, I am very impressed to have so many people ready to listen to a speaker who will speak about value investing, as normally we are a minority business. Most people are growth investors. We are a value investor with a long-term time horizon, and it shows in many ways. First of all, I've been managing the French small cap fund for the last 30 years. In the portfolio, we have around half the stocks which have been owned for more than 10 years for the last 30 years. And the duration of the portfolio is around 5 years, or from between 4 and 5 years. The asset management business is owned by my family. We own something like 7% of the assets of the funds. We are specialized in small caps because it is there where you can find value. We only deal in mutual fund, and we have only one strategy, which is not unique, I'm sorry, which is quality value. And basically, we do what Benjamin Graham told us to do, and he said the best gauge of success of an enterprise is the percentage earned on invested capital, which means it's very easy to beat the market. You just have to buy the book, The Intelligent Investor. The return for the French small cap fund has been 13% for the last 30 years. We have an alpha of 6%. What is quality value? Quality value is an easy way to invest in stocks. Okay, you just have to look at income statement and balance sheet and do some calculation between figures which are in the income statements and figures which are in the balance sheet. The main problem of value investing is when you are successful, there are two traps. One of them is to believe that you are clever and that the results were good because you were clever, and then you become a stock picker, or that the company in the portfolio are wonderful. They are more expensive than they were, but they are still a good investment. What we do is we want to have a discount compared to the market, and we check every day or every month that the discount is still there. We have two criteria, quality, which means return on capital employed or on equity, value, which is a discount on the price we pay. We like to, our criterion is price to cash flow, but we could use price earning, or we could use price to sales, but nobody wants to invest in a fund which would use criterion price to sell. The results are encouraging because, basically for the French fund, the value of the share has gone up 3,600, has gone up from 100 to 3,600 for the last 30 years. Our index 70%, large cap 400%, or 500% if you are nice. As everybody knows, there is a theory which is called the modern theory of portfolio. And normally, we should be more risky than the market. It's very difficult to show that. We outperform the market 76% for all the year. And we had a positive performance 83% of the time. We have an alpha of 6%, which is rather good for the last 10 years, which were a period, according to everybody, which was a good period for growth. We are managing 3 funds, a French fund, 250 million assets, a European fund which was launched in 2018, and a closed-end fund of 50 million euro. We are 4 fund managers. I'm still here, so everybody believes that I will retire tomorrow. It has been the case for the last 6 years, so I don't give any figures now. Audrey has been working with me for the last 12 years. And, okay, my son is not called Audrey Bacot. He is called Victor Higgons, and he will replace me when I retire, definitely. All investors have the same goal: buy low, sell high. Only the definition of what constitutes an investment opportunity change. For us, value investor believes that we are not able to predict the future. So we don't try to do that. So our investment case is lousy, I excuse. We agree that with Warren Buffett that in the business world, the rearview mirror is always clearer than the windshield. Why is it that? If you read What Works on Wall Street, which is a book which made an history of the results of different investment strategy for 50 years, it showed that companies which had a very good growth rate of sales are not a good investment for the next 3 years. Companies whose share price has gone up quickly are not a good investment, because basically companies which had a very good run on earnings per share don't maintain this run. After that, we have many people or many fund managers say, I invest in companies which are well managed. I must agree with that, but as a financial analyst, I wonder whether it's useful if there is no trace of the good management in the figures, why bother? Is it possible to identify companies whose earnings per share will grow faster than the average in the future? I would say most fund managers would say yes, which is rather surprising. Why? There has been a Nobel Prize for Samuelson, which explained why some states were growing more quickly than the other. There has been no Nobel Prize for the growth of companies, and every time somebody or a company like McKinsey has believed that it was possible to have a theory of growth, it was a wonderful failure. For people who read a lot and who are old, remember In Search of Excellence of McKinsey, which explains with 4 cases what a company should do to grow quickly. 5 years later, all the company had big problems, so they wrote another book which has the same success. Okay, there is no theory of growth, which means it would be much more simple if you could say, if I invest in my employees, if I invest in the marketing, if I invest in R&D and so on, I will grow quickly. Basically, there is no theory which works. Okay, but we try, as everybody else, to find companies which are able to grow more quickly than others. And for us, the only way to do that is to look at return on capital employed. If you have a return on capital employed of 20%, every year you will be able to invest more than companies which have a return on capital of only 7%. And at the end, the company which has a return of 4% will disappear. Okay, the only problem is there a permanence of return on capital employed? The good news about it, regulation is increasing. And if you remember what you were taught in university, the model of perfect competition assumes that when you see somebody who is making a lot of money, you will invest tomorrow, open your factory the day after, and compete in the week after. The truth is, now you need a lot of authorizations, and you will be lucky to be, if you are in the industry, to be able to open a factory 5 years later, which means return on capital employed is rather sticky, except in equipment for car parts when the governments decide to kill a business. The good news is if there is no theory about growth, you can't really be sure that a company will grow at a lower rate than the other one. So undervalued companies are a good investment because undervaluation does not guarantee a bleak future. Why value investors have the best return, except for the last 5 years? No. Because behavioral finance validates the value approach. We can't look every day at our portfolio and analyze all the stocks and all the stocks which could be bought. So we have to assume that a good company is a good company, but the reality is there is no persistence in growth rate. So that's called anchoring. We believe that some companies are good companies and it will last. The truth is we are always surprised. And that is the good news because it won't be as much interesting if it wasn't the case. If you look at the stocks in the States, something like 30% of quarterly forecasts are a surprise, which means over 10 quarters, you have only a 20% chance of having no negative surprise. And if you look at what Dreamen said, a value company, which is a company which has a very low price earning, can hardly disappoint, which means a drop in results equal stable price. Basically, you thought the results were good, they were lousy, but you were the only one to believe that. A beautiful company can't have bad results. A drop in earnings implies a drop in price. A good company has good results. A good surprise, stable price. Other biases explain why value investing works. First of all, human beings are presumptuous. I can prove it, but not now. Which means they believe they can predict the future. They don't even know what they will be doing in 1 month's time, but they can predict what will be the earning per shares in 3 years. And there is a confirmation bias. If you find a low price earning, you just know that the company will have problems. Last year, Jacques Metal had a price earning of 2. So you knew that the net income would decrease quickly. The opposite is true. If you look at Hermès, you know, when you look at price earning, that it is a growth company and that everybody believes that it will keep growing. Okay, what we do is use an A quality as a lever, okay? If you invest in a company which has a return on equity of something like 17%, everything being equal, net earning per share will grow by 17%. We are value, which means we want everything. We want growing revenues, high operating margin, high return on capital employed, and a sustainable management. If we look at last year, we managed to have a sales growth little higher than the market, 11 against 10, an EBIT margin of 11 against 8, and a ROCE around 20% against 7. We are very good at looking at finding company with high ROCE. The other way to make money is to buy cheap company. If you buy if you buy nice company which are cheap, you can expect the price earning to grow little by little, year after year, and make some money out of it. Why there are some good companies with low valuation? One explanation is family businesses don't bother a lot about marketing. If you want to have a high price earning, you should say, I will grow quickly for 5 years and I will increase my margin. Which means if your price earning is 20 on historical figures, it's something like 10 in 5 years' time. And if you like news flows, you will say, okay, I am buying 10 times the net earnings in 5 years' time, and I will have a very nice news flow between. If you say, I'll try my best, I don't know what will happen, you will keep your price earning of 10. And basically, we don't believe that companies are able to predict an improvement in margin. We believe that even if you do everything well, if your competitors do the same, the customer will benefit and you won't increase your margin. So it's very difficult to know whether or not a company will increase its margin. And I understand why family businesses don't try to oversell what will be the results. One other reason is if you are the only company in a sector, nobody will follow you. And small size, of course, basically is something which make brokers uninterested. Okay, what we do is we invest in companies which have a high return on equity, which have a low valuation. Low valuation is very strict. We have a discount compared to price cash flow of around 30%, and a return on capital employed today, which is huge compared to the market. I think it's an aberration, but it lasts. After that, we do what everybody does. We go and visit companies. The surprising thing is, as those companies don't do a lot of marketing, financial marketing, I say, it's difficult to visit them. But when you are there, they love you because they know that it has been difficult. And you get some good information. Okay, what we do is some financial analysis, some market analysis. We meet managers, and we do some ESG analysis. Compared to other fund managers who said, there is no broker report now, the small cap sector has been abandoned, and so we can't do anything about in this sector. I say the opposite. The truth is annual reports are wonderful, and if you read an annual report, you will be a specialist, of the stock. So it has been much easier than it was before. Okay, from what I said, you understand that I don't do some predictions about the company in the portfolio. We are more statistically inclined, which means if we have a portfolio with a price earning of 10, a return on capital employed of 20, we will be very happy, even if we don't analyze the company in the portfolio. Okay. The other thing is, fund managers don't have the time to analyze the company in the portfolio. Okay. I was a financial analyst. I needed 1 month to analyze a company. I'm getting older, so probably I need 2 months. And the truth is, we are 4 people to analyze something like 100 companies per year, which means 8 days per company. So if we were able to make a nice presentation of 30 pages on a company, it means it would be strange. Okay. So if you look at Delta Plus, which it's the oldest stock in the portfolio. It has been bought in 2006, and the people clever in the room will notice that we don't give the figure in 2006 because we are not very good in archaeology, so we couldn't find figures for this period. In 2011, the EBIT was 12. It's now 54. We started with, we were one of the main shareholders of the company, which is not the case now. We have been selling this stock for the last 15 years. But it has been growing rather well. Okay, I have 5 minutes, so if you want to ask questions, you can. So it has been growing rather nicely, and what happened is that the price earning went up from 7 to something like 14, which explains why the market cap went up from 59 million to 555 million. Okay. I won't say that in 2006 I thought that equipment for individual protection was a growth market, that the Chinese would use in equipment for individual protection. In fact, the chairman of the company said the opposite. He told us that Chinese didn't bother with protection. And one of the reasons why it has been growing, it has been Chinese for the last 5 years have been using individual protection. Last case is Katana. We bought it with a price earning of 6. Basically, the price earning is something like 9 today, but the EBIT has increased by a huge amount from 6 in 2020 to 34 this year. Okay, so we spoke about it. The results of the European fund are as good as the French one. They even showed that, okay, the young people manage the European fund. And so they showed that for a given period, they were able to beat the French one, which I manage. And we have a new product, which is Family Value, which invests in very small cap and with a time horizon of 7 years. Okay, I think I should stop, so I do. Is there any question? Yeah.
It's me. It must be. Oh, no, there it is. Thank you for the presentation. Very interesting. I do the same. I try to do the same for Italy. I have a small cap fund that invests only in Italian small caps. Question. You say you look more at numbers and you're skeptical about predicting the future. But at the same time, you're focusing on France only, which means that you also place a lot of value, as I do, in knowing the management and knowing that the people behind the numbers are people able to transform the numbers into the future. Otherwise, you wouldn't invest in them, right? It's a qualitative aspect.
Okay, we launched 4 years ago a European fund. I didn't want to do that because I thought the same as you did. But we discovered that the strategy was explaining most of the alpha. The fact of knowing the company or working, because if you just use a formula, you don't need to work, which is a nice thing, brings a little something. But basically, if you invest in low price cash flow...
But that's what I'm saying. So your approach, which is not mine, it would be open to invest globally. I mean, if you don't have to... If you just look at the numbers, you could...
Yes, you could do that. No, because...
So my question to you is, why restrict your...
now we have a European fund. When we started, we didn't know anything about European stocks, except France, of course. So I was afraid about it. And basically, that was the funds were given by the fund management company because I thought that the result would be awful. And basically, they managed to have an alpha of 4%. But compared to France, European small cap are more open to speak every trimester, so we have a better information than in France.
Okay, thank you.
Yeah, a question concerning the Delta Plus that I believe you still own. That was a partial sale. Well, how is the competitive position for a company like that? How do they compete against, let's say, lower cost
They compete
producers?
against 3M. 3M against, I don't remember the name, an American company. There are two very big companies which are global. Delta Plus which was 20 years ago a French company, which production in China is now a global company with subsidiaries almost everywhere. Okay, it has become a global company, and there are two American companies which are global, and after that there are local ones.
Hi, thank you. You are very explicit about the criteria to get in. What is the kind of criteria you use to get out? And especially in Delta Plus, where
that is where we are not value. Okay. When I started, there was a company which was called Matra, and the stock went up from 8 to 20. And I thought that value investor had bought the stock at 8, sold it at 12. Normal investor had bought it at 12, sold it at 16. And growth investor had bought it at 16 and sold it at 20, let's say. And I thought the good strategy is buy at 8 and keep it until 20. But for me, risk is correlated with price, which means as soon as the price is higher than 15, we start selling. And when the price earning is 20, normally we shouldn't have any share. Okay? And we use momentum. Momentum is very useful. If the price of a stock is growing quickly, we sell more slowly. There is an inverse relationship, and it works rather well, because sometimes you are just plain wrong. You believe the stock is expensive, but basically the net income is higher than you thought. Or there is a takeover which will take place, and everybody knows about it except you. So we use a little momentum. But, okay, we do that, but we want to have a discount of 30% for the total portfolio. That is the discipline.